Imagine hedge fund managed by Nobel Prize winners generating millions in profits, only to suddenly collapse, losing billions and sending shockwaves through the global financial markets. What went wrong? In this episode, we will look at how excessive leverage, complex options strategies, and overconfidence led to this disaster, and more importantly, what we as individual traders can learn from it so we don't make the same mistakes. Long-term capital management, or LTCM for short, was a hedge fund launched in 1994 by John Meriwether. Meriwether had previously made a name for himself as bond trader at Salomon Brothers, one of the largest investment banks in the world. But it wasn't just Meriwether's name that drew attention. It was the team he has assembled around him. LTCM brought together a group of exceptional minds including two Nobel Prize winners, Myron Scholes and Robert Merton. These two academics were behind the development of the Black-Scholes options pricing model, a formula that revolutionized financial markets. With a team like that, LTCM gained tremendous credibility and quickly earned the full trust of investors. So why was LTCM so successful in the beginning? The fund specialized in what's known as bond arbitrage. In simple terms, it profited from tiny price differences between various fixed income securities. For example, if two similar bonds were trading at slightly different prices, just a few basis points apart, LTCM would enter position expecting those prices to eventually converge. On the surface, these trades didn't seem risky at all. In fact, they were considered safe and based on solid mathematical foundations. Their strategies were built on high probability outcomes but with low profit-to-risk ratio. That's why the fund relied heavily on leverage to amplify small returns into impressive results. And it worked well as long as markets remained stable. But this approach carried massive risk in extreme conditions. LTCM borrowed vast amounts of money, up to 30 times its own capital. This allowed them to generate significant profits from even the smallest price movements. In practice, even tiny shifts in bond prices could lead to huge gains. And early on, it truly paid off. In its first few years, the fund delivered annual returns of up to 40%, an astonishing performance that attracted capital from around the world. On the chart, you can see how quickly LTCM grew between its founding in 1994 and 1998. As the graph shows, long-term capital management turned out to be more of a short-term capital management success story. But LTCM early success wasn't just about the numbers. A key reason behind the fund's rising popularity was the prestige of its founders. With each year of strong performance, the reputation of Nobel-winning economists grew. Their presence gave investors the sense that the models were infallible, that risk has been engineered away. What's more, other market participants began to imitate LTCM strategies, further reinforcing the belief that these were proven and safe methods. The mindset was widespread. If the world's best minds, Nobel laureates, are running this fund, there is no way these strategies can fail. In addition to its core bond arbitrage strategies, long-term capital management also used options as a key part of its investment approach. Options allowed the fund to hedge position, increase leverage, and take advantage of small discrepancies across different markets. Interestingly, LTCM was one of the largest sellers of volatility on the S&P 500, actively selling long-dated index options, which meant the fund was net short volatility. In other words, LTCM was betting that the market volatility would remain lower than what was priced into options. And for a while, that strategy worked. But eventually, it backfired. The fund lost 200 million in a single day on these trades alone. The options that were originally meant to protect LTCM positions ultimately became the part of the fund undoing. High leverage and enormous exposure combined with an unexpected surge in the market volatility put LTCM in a position it couldn't easily escape from. As the fund tried to unwind its positions, it actually triggered additional markets movement and volatility, which amplified its losses even further. In the end, the combination of complex option strategies, extreme leverage and unforeseen market conditions in 1998 led to collapse of LTCM, a failure so massive it nearly triggered a global financial crisis. The collapse of long-term capital management in 1998 was one of the most dramatic events in modern financial history, a failure so severe it nearly triggered a global financial crisis. It all began in August 1998, when Russia defaulted on its debt and suspended payments. This shock sent ripples through global markets. LTCM had placed series of trades based on relative value arbitrage, shorting expensive bonds, expecting them to fall, and going long on cheap bonds, expecting them to rise. But the exact opposite happened. Cheap bonds fell even further and expensive bonds became even more expensive. As panic spread, investors started liquidating assets, causing a sharp spike on volatility, the very thing LTCM had bet against. The result? The fund lost over 1.7 billion in just few days, an event so extreme that its mathematical models consider it almost impossible. On September 1st, LTCM still had 2.3 billion in capital, but by September 22nd, that number had dropped to just 600 million. In desperation, John Meriwether sent a letter to investors offering favorable terms for new capital injections, but the effort failed. An unexpected rescue offer emerged from Goldman Sachs, AIG, and Warren Buffett. Interestingly, Buffett had declined to invest in LTCM back at its launch. Now, however, he offered 250 million to acquire partners' stakes, along with 4 billion capital infusion to stabilize the fund. LTCM leadership, hoping for better terms from the Federal Reserve, rejected Buffer's proposal. On September 23, 1998, the same day Buffett made his offer, the Federal Reserve Bank of New York stepped in. They assembled a consortium of largest banks, which injected 3.5 billion into LTCM to prevent broader market collapse. These banks took over 90% ownership of the fund and assumed control of its position to avoid systematic risk. The Fed intervention wasn't a direct bailout, but rather a coordinated effort to stabilize markets and prevent further breakdowns in the global financial system. Despite the rescue, LTCM never recovered. Over the next 2 years, its positions were gradually unwound, and by early 2000, the fund was completely shut down. The fall of LTCM became a landmark lesson in modern finance, showing how dangerous extensive leverage, complex trading strategies, and blind faith in mathematical models can be, especially when those models fail to account for unexpected market shocks. The collapse of long-term capital management carries several key lessons that are just as valuable for us, individual traders, even if the scale of LTCM's operations was far greater than anything we typically deal with. Let's look at the most important takeaways. Risk management. Perhaps the single most important lesson from LTCM downfall is the danger of excessive financial leverage. At its peak, LTCM operated with leverage ratios as high as 30:1, meaning that even small market movements could translate into huge losses. And that's exactly what happened. Leverage amplified the fund's exposure until it could no longer absorb the shocks. As retail options traders, we need to be extremely cautious with leverage. Yes, it can boost your returns, but it can also magnify your losses just as fast if the market moves against you. LTCM also reminds us the importance of true diversification. On the surface, their portfolios look well balanced, but in reality, many of their positions were highly correlated. When trouble hit, losses in one part of the portfolio spilled over into others, creating a cascading effect that accelerated the fund's collapse. The takeaway? Make sure your strategies are genuinely diversified and that you are not exposed to compounding risk if several assets start moving together. For example, if you are holding positions on Apple, Microsoft, and QQQ, you may think you are diversified, but in reality you are heavily concentrated in one theme, large cap tech, and essentially one instrument, QQQ. A liquidity crisis was another major factor that contributed to LTCM's downfall. During the broader financial panic, market liquidity dried up and the fund struggled to close its positions, which only deepened its losses. As option traders, we need to be aware that liquidity can vanish quickly, especially during periods of high volatility. This can make it difficult to exit position, particularly when the market is moving against you. Another key point is the volatility of correlations. LTCM built many of its strategies around the assumptions that price discrepancies between related assets would eventually converge. But in the times of crisis, correlations between assets can shift dramatically. That's why it's crucial to be prepared for the fact that relationships which appeared stable in the past may break down unexpectedly. You can protect yourself by adjusting position sizes and actively managing risk. Strategic thinking. LTCM relied on advanced mathematical models, but their collapse reminds us that no model is perfect. Even the most sophisticated algorithms can't predict black swan events, those rare but destructive market disruptions. No matter how sound our strategy is, we must accept that it can account for every possible scenario. There are always unknowns. And during extreme market conditions, like the ones that brought LTCM down, the limitations of even the most robust system become painfully clear. The psychology behind it. One of the key factors behind LTCM's collapse was overconfidence. The team behind LTCM was made up of intellectual heavyweights, including Nobel Prize winners. This led to a sense of invincibility, a belief that their strategies were virtually bulletproof. And as more investors began to imitate their approach, their confidence in the models only grew. For us, this serves an important reminder: humility is essential in trading. No one can fully predict what the markets will do, and overconfidence can lead to reckless decisions, sometimes with devastating consequences. The lessons from LTCM also reminds us of the importance of routinely reviewing our strategies and testing them under a variety of what-if scenarios, especially the extreme ones. We need to regularly assess how our options position might behave in stressed market conditions and what risks we are exposed to when volatility spikes or correlations break down. Ultimately, The story of LTCM is a powerful reminder that markets are dynamic and unpredictable. Success in trading comes not from having a good strategy, but from managing risk, staying flexible, and approaching the market with discipline and responsibility. Thanks for watching. If you enjoyed this video, hit like, click subscribe and share it with someone who might find it useful. Don't forget to visit optionwise.eu, sign up for the newsletter and grab your free ebook Options One-on-One, your first step towards smart trading. See you in the next episodes.